Some traders make profits by spotting tiny price differences between markets. It's called arbitrage trading. But while it might sound like easy money, it's far from risk-free. In this video, we'll break down how arbitrage trading works, what to watch out for, and how to track your trades for tax time. But before we go any further, I just want to say that this video is for general information only and should not be taken as financial, investment, or tax advice. Always do your own research and consider seeking professional guidance before making trades or investment decisions. Alrighty, with that out of the way, arbitrage trading has been around for decades, from traditional markets to crypto exchanges. It's all about identifying short-term price discrepancies and acting fast. But between fees, liquidity, automation, success takes more than timing. It takes strategy and awareness of the risks. And if you're crypto trading, don't forget, every trade could have tax implications. Koinly helps you track and calculate your taxes automatically, so you stay organized when it matters the most. Okay, so as we said earlier, arbitrage trading involves taking advantage of price differences for the same or similar asset across different markets. For example, if a stock is selling for $20 on one exchange and $20.05 on another, a trader might buy on a cheaper exchange and sell on the higher one, profiting from that small difference. Arbitrage helps keep markets efficient, as these opportunities tend to close quickly once traders act on them. So how does this work? In essence, arbitrage relies on speed and execution. Once a price gap appears, markets usually adjust fast, sometimes in milliseconds. Many traders therefore use algorithms or bots to identify and execute trades automatically. While arbitrage is often described as low risk, it isn't risk-free. Transaction costs, delays, and liquidity issues can all reduce or eliminate potential profits. So here are some common arbitrage strategies. Simple or pure arbitrage, buying and selling the same asset across different markets simultaneously. Merger arbitrage, buying or selling shares based on potential acquisition deals, depending on whether the merger is likely to go through. Convertible arbitrage, exploiting price differences between a company's convertible bonds and its stock. Triangular arbitrage, converting between three currencies. For example, USD, Euro, British Pound, and then back to USD. And this is used to capture small exchange rate discrepancies. Statistical arbitrage, using quantitative models and data analysis to identify and act on price anomalies. And then we have crypto arbitrage trading. In crypto, arbitrage takes advantage of the price variations between exchanges, something that's common in a decentralized, always-on market. Example, Bitcoin might trade at $45,000 on Coinbase and $45,200 on Kraken. A trader could, in theory, buy on a lower priced exchange and sell on the higher one. But transaction fees, withdrawal delays, and volatility can quickly erase potential gains. So it's not as simple as it sounds. Okay, so why do price differences happen? Price differences occur because crypto markets are fragmented, with varying demand, liquidity, and trading volumes across exchanges. Decentralized exchanges often rely on automated market makers, while centralized exchanges use traditional order books. These different systems can result in short-lived price gaps. Okay, so let's talk about benefits and the risks of arbitrage trading. The potential benefits. It helps promote fair pricing and market efficiency. It can increase market liquidity. It offers diversification opportunities for experienced traders. Okay, some common risks include high transaction and withdrawal fees, execution delays or failed orders, low liquidity and slippage, model or software errors, and a changing market or regulatory conditions. Arbitrage may seem simple in theory, but in practice, it requires experience, capital, and careful risk management. Okay, what about tools and bots for arbitrage trading? Many modern arbitrage traders use automated bots to monitor markets and execute trades. Examples include CryptoHopper, which offers triangular and market arbitrage across multiple exchanges, CoinRule, which is user-friendly and ideal for beginners using preset strategies, Phoenix, which provides a spot futures arbitrage bot and built-in automation. Okay, these tools can make trading faster, but setup and monitoring still require human oversight, and profits are never guaranteed. So how do you get started with crypto arbitrage? First of all, do your research. Understand the markets, fees, and timing risks. Pick reputable exchanges. Choose platforms with fast transaction speeds and transparent fees. Automate carefully. Consider using bots, but know how they work before deploying real funds. Make sure to track everything. Record your trades and outcomes, especially for tax purposes. Remember, no strategy eliminates risk. Start small, learn as you go, and never trade money you can't afford to lose. Alright, arbitrage trading and taxes. Every trade, whether profitable or not, can trigger a taxable event. Gains, losses, and fees all need to be accounted for accurately. Doing this manually can be complex, especially when trading across multiple exchanges. That's where Koinly helps. Koinly automatically imports your trades, calculates your gains and losses, and prepares easy-to-read tax reports. It's not tax advice, it's just an easier way to stay compliant. Arbitrage trading can be an interesting way to explore market dynamics, but it's not a guaranteed profit strategy. With proper research, risk management, and the right tools, you can trade more confidently. And when it comes to taxes, Koinly helps you track and organize everything automatically. For more crypto guides and updates, make sure to check out our blog, which is updated regularly by our content team. Got experience with arbitrage trading? Let us know down below. If you enjoyed this video, consider dropping a like, subscribing for more crypto content, and I'll see you next time. Peace.